Hi, this is Justin Carlson from East Daily. We are waiting for a few more folks to get on, and then we're going to get started here with the presentation. So if everyone on the audience will just stand by, we will get started momentarily. Hi, everybody. This is Justin Carlson from East Daily. We are waiting just another minute here, and we'll get going. All right, well, welcome to East Daily's DLS, Dirty Little Secrets After Hours webinar. I appreciate everybody's attendance. My name is Justin Carlson. I'll be walking you through the presentation. I'm the Chief Commercial Officer here at East Daily. And with me, I actually have Chris Noonan. Chris is the head of our sales team, and he's going to join me and represent a bit of the voice of the customer. He's been on the road a lot lately presenting this deck to customers and clients, and has got a lot of questions, and so certainly wanted to bring him in and filter in some of those questions as part of the conversation about what's going to happen in gas markets. So for those of you not familiar with us, the Dirty Little Secrets is our annual report, so this is a bit of an addendum to that, the after hours, so to speak. I thought I might do this on Valentine's Day, but my wife said that was not acceptable. So we were post Valentine's Day. Nevertheless, we were going to have a little after hours and a little after party, so to speak, with respect to DLS. This is called the Natural Gas Undoing Project. Part of that is, based on my history in the industry and a lot of undoings that we're going to explore as we go throughout this deck. So we'll cover that here shortly with some themes and agenda. Quickly, though, I did want to touch on who we are for those of you that might be new to East Daily. I'm not going to spend a lot of time here because it's and all of this looks very complicated. It's really very simple. At East Daily, we take a lot of data. We put that data into models, and we run that through, sort of cross-industry, cross-functional balanced models, the value chain, so to speak, as you look at that upstream, midstream, and downstream. And it's really more about the relationships between the data that's really important to us and what that says about the data. And then the third component of that is then to run that through the financial outcomes from that data and that modeling. And that's really about what can running this data through a value chain and then determining how it impacts the financials of individual assets tell us about the data, about the accuracy, about the forecast for the future. So it's really those three things that are a core part of our methodology and what makes us different.
Thanks, Justin, and everybody on the line. This is Chris Noonan. I have the sales and marketing team, and I'm going to encourage everybody on the call to do a couple things. One, last year in Dirty Little Secrets, we started playing out this natural gas theme, and then this year in Dirty Little Secrets that came out in December, we explored it more, and now we're continuing down the theme of the oversupply of gas. You'll see on the screen that Justin has up, you'll see a QR code. If you're interested in signing up to receive our daily blog called The Daily Note. I'd encourage you to do that if you haven't already. Also, go on our website, download Dirty Little Secrets, and you can get a more in-depth look at how we see the market. We consider ourselves infrastructure and volume experts, and that's how we view the market. And so I think you'll see a little bit of that in this presentation. So Justin, back over to you to kick it off.
Thanks. We'll dive right in. So some of the big themes and agendas that we're watching in the gas markets that we explored in DLS and that we are digging a little deeper in this after hours content is that concept of the undoing. And the first part of this is, and we're starting to see some of that now, and we'll talk about it, which is the undoing of this, short-term supply momentum. There has been a lot of new infrastructure that has been announced. Some has come online. Even more will be coming online. That's encouraging producers to drill despite the imbalance in the market. And we're going to explore what that imbalance looks like. And our assessment of the current market is, while prices have come down, they have not come down enough, meaning that there has not been enough pressure to force supplies back in order to balance the market short term. So we really feel, as we look out, that there's going to be an extended period of this 23 to 25 timeframe where we're going to see a lower price environment until we get an offsetting demand side response to really start to lift markets. And at that point, we're going to see a rapid flip in what needs to happen in order to balance the markets on the other direction, meaning we'll need much more supply than we need today. So it's a bit more of a defer of supply than it is necessarily a we don't need it. We're going to need it, just not yet. The second undoing is this high price environment. We've certainly seen that happen. We talked about that through DLS, and of course through January we've watched prices come down dramatically. And that, again, is been, in our opinion, the right answer or right response for the market to send the right signals to producers that there needs to be a bit of a slowdown, or again, as I said before, a shift in supply. The third undoing that we need to talk about is this very laser focused on the Permian. I know that's what we've been talking about with our clients for, quite frankly, many years now. But the Haynesville and the Marcellus, in my mind, if you aren't watching those, you really aren't watching the gas markets, because that's where the pressure is coming from, is how much supply producers in those basins could put into a market that simply can't support it. The other interesting note, maybe a bit more longer term from an undoing, is the thought that, hey, the Permian can supply our demand needs for the future. Well, no, we need to focus on, and Marcellus and Haynesville for that matter. No, we see a huge opportunities for other basins, and the timing at which those basins have that opportunity really depends on the rollout of LNG. So we're going to explore that here as we get through the deck. And then this 20 years of being supply long. Listen, I've been in this industry and been analyzing markets since about 2008, and I entered at a time in which we were supply long, and everything was changing with respect to horizontal drilling and fracking, and the Barnett and the Haynesville and the Marcellus, and then we've been back to the Permian, and so for the extent of my entire time frame in this industry, we've been supply long, and I think by the end of this decade, we'll enter a period where producers are racing to catch up. So that'll be an interesting flip from where we've been.
Thanks, Justin. For the audience, what we did in this presentation was we thought the timing of everything and the infrastructure was going to be really important. So what we're going to go through next is the infrastructure build to get to the LNG facilities. And you'll start to see the timing and also where those facilities are being built and where the pipes are going. And it will start to, in your mind, kind of play out the full story. And we'll be monitoring this over the next 3 to 5 years and continue to see how it plays out.
Thanks, Chris. The first phase of that is represented in this super build. So what we have in this first phase is the period where we're going going long, So you see that in 2023. That phase starts out, I'm going to build this out, and I'll do it relatively quickly, but started out with Gulf Run coming online in January 1st of this year. We see Gulf Run moving about, it's technically moving much more than 500 a day, given the integration with CP line, but it's moving about 500 south. into mostly trunk line. So that's a lot of gas that is now moving out of the Haynesville market, or that was previously moving on other pipes within the Haynesville market and moving down towards lower Louisiana. What it also enables, and that excess capacity enables, is more supply to get out, because the Haynesville was previously constrained, basis was weak, and now this has opened up the coffers, so to speak, in order to allow producers the availability of capacity to get out. We follow that up with the restart of Freeport. Now, Freeport we don't see as new demand. It is simply just demand that's returned, and in our opinion, it could actually send false signals to the market that we have more demand than we really have. Freeport was here last year at the beginning of the year and through most of the year. It's simply been deferred for a while. So we don't see Freeport as new demand, and it could even send the wrong signals to the market that we need more supply. You follow that up with Altamira down there on the actually New Mexico Gulf Coast, but my map is cut off down there at Texas. But nevertheless, it's about 400 a day. That's quickly followed up by Whistler, which completely offsets that in that South Texas market. We see the Permian as a whole continuing to drill. We've actually seen a ramp in drilling and rig activity, and so any new pipe that comes online, we believe there's latent supply behind those pipes to fill those almost instantly. And we saw that with GCX, and we've seen that with most of the pipes that come out of the Permian. They fill much faster than market expectations. That is then very quickly followed by the first phase of LEAP. A lot of this subscribed by Southwestern Energy, out of one of the largest growth producers in that Haynesville area, along with Comstock and Atheon. So LEAP will come online again, more additional capacity heading to the southern Louisiana market. PHP comes online, another half a B at the very end and the tail end. Now, I want to note these two Permian pipes don't come in until the end of the year, Q4. So that's important from a timing perspective. We've certainly baked this into our supply demand outlook for the Permian, but it's important from a timing perspective on how those come in, because they're not going to impact the storage market or the prices as much in the short term. It's the long term and heading into 24 that those will have a bigger impact. So we've ended 2023 where we've effectively added almost 3 Bs of new capacity to move out of supply markets, and we effectively haven't really added any new demand. So that's important, or that's what ties us into the long position before we head into getting longer.
And to clarify, because we get this a lot, when we say long gas, it means we're bearish prices as well.
Yeah, thanks, Chris. We'll start off well in 2024 with Golden Pass coming online. That's sort of the home for Gulf Run, so that those producers will have a new home, a new demand source. LEAP Phase 2 comes online. You get Louisiana FLNG. This is a bit of a spec. I think we're going out on a limb here to say they get that done. I could see that not coming in. It's not FID'd yet. It's a small facility, though, so it really won't impact our overall outlook. Then we get LEAP Phase 3, followed very quickly by Matterhorn. Now, this changes everything, because now we've got 2 BCF, and as I said before, we expect these pipes to fill up very quickly. When we expect there's enough latent supply behind Matterhorn to fill that very quickly as we dump 2 Bs into that South Texas, the Katy market. Then you get NG3, 1.7 Bs, again, adding available capacity for producers to get out of the Haynesville. Louisiana Energy Gateway, more capacity for producers to get out of the Haynesville. And then finally, you've got that LA Energy Pathway. That's a bit more about connectivity, but it's signed up for by a major producer. So whether that's we don't exactly know who that shipper is, but whether that's let's say Eagle Ford supply getting out, or whether it's Permian coming across, it does provide connectivity across those markets. In total, and what's important here is we've added 6.5 Bs of capacity out of the Haynesville. We've added 3.1 Bs of capacity out of the Permian and out of Waha, and yet we really haven't added any substantial new demand at this point, because we are now just teed up for what comes in that 26, 27 timeframe, was a period where we get shorter. So I'm going to build this out relatively quickly, but we get a whole host of new facilities that come online, Corpus Christi and Delphin and Commonwealth. And we'll dig into these just a little bit more in an LNG stack later on. So I'm not going to spend a lot of time on these facilities, but nevertheless, we just get this run of build out for the amount of new demand that's coming along in the Gulf Coast area. So what's the takeaway from this is we had this period where we've been long, we got longer, or again, with the potential to be longer, and yet we didn't have any new demand till 26, 27 showed up. And at that point, we now have 4.22 BCF per day in the lower Texas Gulf Coast market, and almost 13.76 BCF per day in the upper in the Louisiana Gulf Coast market. Yet we only built 6.5 Bs of supply, or the availability of capacity down there. Again, that was a constrained market. So now we have a mismatch. We don't have enough connectivity in Louisiana. So we would expect a significant number of new projects in order to provide the connectivity needed to meet this future demand pull. And same thing with South Texas, with 4 Bs of new demand between Corpus Christi and Rio Grande. Again, you end up with a point where we haven't provided enough new connectivity in order to facilitate this new demand.
Yeah, thanks, Justin. I think, one of the questions we get is, and you just covered it, South Texas, Houston Ship, they're getting a lot of gas pumped in there, and most of the demand in 2-3 years is coming into the Henry Hub, Louisiana area. So we're diligently watching that to see what's going to be announced and can they get the gas up into that area.
So let's dig into some of the graphics and some of the tables that showcase the numbers. So as I said, the Undoing project, we've got the short-term supply push. So this is a bit more focused on the short term, which is what you see on the graphs there on the right. That is just blanket 5-year average storage numbers. And what we noticed, and we first published our first macro supply demand report in February of 2022. And one of the primary reasons that we published it, and the dynamic we were seeing was represented by that blue line. We come out of COVID, you can see prices below there on the bottom chart. Prices had started to lift, and we saw this surge in momentum of rigs. We'll look at rigs on the next graph, but rigs started to climb, IP rates were good, production was coming out of the ground, and to us, based on a normalized demand level, we were going to blow through storage. And you can see that in the graph above. 2022 wasn't the problem. It was 2023 that looked to us like we were headed for a problem, because momentum simply was too high relative to the fact that, again, we didn't have any significant new demand. The market for gas in the U.S. wasn't changing for significantly enough to absorb this run-up in supply and the productivity that we were seeing from the basins. Then along comes the summer. And of course, what happens in the summer is prices skyrocketed, particularly in the power markets. We saw a massive uptick in the amount of demand, some of the highest power markets that we've seen in history, pulling down storage inventories at a rapid rate. As I said, we didn't have a problem with supply. We were well balanced in 22. It was 23 that was a problem. So that imbalance where we went really short gas drove prices up. You can see that in the bottom where we had prices closing in on over $8 and the forward curve closing in over $10 at times. And so we had this massive run up of price, which just further exacerbated the problem. We had drilling rigs show up in the Barnett and then in the Eagle Ford, and the Anadarko started to increase. So it wasn't just the Permian growing now, it was everybody was growing. And that just exacerbated the problem. It led to DLS, and one of the major themes that we've talked about in DLS and throughout the end of last year was this massive overbuild this overproduction based on the momentum of supply going forward. And you can see in that forward curve, which is where we set long-term rig outlooks, is based on that forward curve. It was simply putting too many rigs on the market and just this escalating effect of that green line, which blows through the 4 TCF sort of limitation, theoretical limitation on storage levels. And then the last piece is where we ended up today. So this is where our latest macro S&D report that will come out, I think tomorrow or in the next few days here, is we've now seen this massive shift in prices. in particular a response to weather, which has definitely helped and allowed us to adjust some of our expectations both on the demand side. So now we're getting power levels back towards where they were last year or closer to where they were last year. Still a little bit light, but closer. It makes me a bit nervous just with respect to last year being as high as it was, given how warm it was. But nevertheless, we've been able to bring down that storage curve. It's also allowed us to reduce a little bit of our supply expectations, given that the forward curve has fallen so drastically. We can then take our rig outlook and drop it now relative to that regression model that runs our forward curve in rig analysis. And then we've also taken the added step of reducing a bit of the drilling activity, or excuse me, the duct builds, which we'll talk about here in a minute.
Yeah, thanks, Justin. So one thing, we're going to look at rigs next, and we've seen some producer response. We don't think it's enough, but in the coming weeks in our content, our dirty little, or in our daily note, we're going to start to explore what producers said last year and then what they're saying this year. It's an interesting time to start to see what producers are going to see and how they're going to respond to these low price environments. So look for that coming out here shortly.
One more note, Chris, just to make, because I don't think I can make this point well enough or boldly enough, which is to say, as of December, we were 5.2 BCF per day long in the market. That's both a component of supply and demand. Through increased demand and reduced production, we've been able to reduce that to 2.7. In my opinion, that's the easy stuff. The hard stuff is yet to come, which is how do you reduce it now another 2.5-ish in that area. And that's where the work's got to come, because it's not going to come easy. And we'll explore that here in just a second. So with that work, what we have here is a chart on the growth. And again, a couple of points I want to make here. One, you can see in the top table there that primarily the growth comes from the Permian and the Arklatex. Those are the two major growth basins that we have. Now, again, as I noted earlier, a lot of that growth for the Permian is back weighted as those pipes fill almost instantly towards the end of the year. And again, this is an average year on year. So we're also comparing this to, all of 22 and all of 23. The other thing to note here is we've got a backwardated curve, or our curve suggests that, particularly the oil curve suggests, as Permian rigs dominate that in the gold area there, suggests that we're going to see rigs come off throughout the course of the year and into the future. That becomes an important component later when we talk about the Permian, but nevertheless, we are reducing rigs, and yet we still have this amount of growth. We still have that uptick in production. And then on the bottom left there, you can see that shift in the production profile to where the blue line represents where we were last year in February of 22 when we put out our macro supply demand report. Then we ran up throughout the course of the year to the green line where we saw rig activity, and the forward curve justified or suggested a very rapid growth in production that we could not see. This is an unconstrained model. So when I say that, I mean unconstrained by demand. We could not see the demand sufficient to absorb that amount of supply. Now with the price correction, we've come back down to a red line. We're basically back to where we were last year at this exact same time. And we still have some more rectifying to do because there simply is not enough new demand coming into the market. And we're not going to find 2.7 Bs above in power markets in order to absorb that.
Yeah, and one other thing we're monitoring is the Permian growth in gas. So as the associated gas and parts of the Permian get gassier, we're filling that into our models, and we're continuing to monitor that as the Permian will continue to grow.
So what does it take to balance the market? We simply need to reduce production significantly, but easier said than done. As I said, that last 2.5 Bs, or excuse me, I think it's 2.5 Bs, is going to take some work. And what we looked at when we looked at this phase 1, phase 2, is reductions in primarily the Haynesville and the Marcellus. Now, we've already been able to reduce a decent amount in our Marcellus. We did not see the winter surge. For any of you on our TDN this morning, we talked about that about the, I think we called it something about flat being the new flat Marcellus supply curve. And that is a function of we did not see producers come back in the same way that they have in the last 2 years, particularly to capitalize on higher winter prices. However, again, what we'd like to see, or what we expect to see more of, is a bit more of that gold area, which is a rig reduction and a DUC build, and possibly choking back or shut-in of wells in order to balance the supply further to get us to a more even keel. To do that, as we played with this force balance and tried to determine, we went through our production scenario tools, our production models, and we cut rigs, but we also built DUCs. Now, in one way or another, it doesn't really matter, meaning if you cut more rigs and don't build DUCs, or if you cut less rigs and don't build DUCs and choke wells, or if you shut in supply, something needs to change to shift the supply dynamics. And so in this case, what was easier for us to do is to look at how many rigs and how many DUCs. And in our case, we built a 750 DUC inventory, including 350 in the Arklatex. In addition to cutting drilling activity, across the Eagle Ford, Northeast, Arklatex by 35 rigs. So that amount of cutbacks is what it took to get that market to balance. And we'll look at how that balance looks like in a second. I do want to make note of this phase 3, which is that ramp. And as LNG ramps up, we expect that producers will have to significantly ramp up. So anything that we do in the short term, i.e. the 23-24 time, we'll have to have a complete reversal of in the long term, starting about 2026, 2025 into 26, 27. We'll have to see a complete reversal of in order to build enough supply to carry into those facilities.
Hey, Justin, one quick point of note. Arklatex we have listed there, that's basically our Haynesville look. There's a few other areas of the Arklatex that we include in there because they are pulling gas out of there. And two, Tier 1 basins, we were talking about this yesterday. We do now include Haynesville in our Tier 1 basin outlook, and we'll get into the Tier 2 basins here in a little bit.
The one challenge with that is then to dig into the Arklatex and look at in Haynesville, and I appreciate that, Chris, because it includes primarily East Texas as well in our modeling, is to look at some of the major producers there. So on average in 2022, you see Aethon there ran 14 rigs, Comstock 7, Southwestern 9. Those are going to be three of the big growers. If you continue their trajectory into 2023, some of the big growers. And I know Comstock just came out. They were, I think, running 9 rigs. So we had an average of 7. They were running 9. They said they're pulling back to 7. So as you can see in this modeling, they suggest, or our analysis suggests, that even at 7 rigs, they're still going to grow over 400 a day. So that is too much supply, in our opinion, that the market can absorb. So I'm not saying Comstock won't do it, and I'm not saying they won't grow. What I'm saying is if Comstock is going to grow and continue that path at 700, or 7 rigs, to produce growth rates of around over 400, in all likelihood, it's going to cause prices to go lower, and somebody's going to have to flinch. We certainly saw EQT flinch in 2020 during the COVID period when prices went down to $1, $1.50 in that area. I wouldn't be shocked to see that again, and particularly in the shoulder seasons. As we come up on April here, we might see a resurgence through the middle of the summer, but then again, as we approach August, September, October, we could see shut-ins again because of a low price environment and a deferral of some of that supply till later. We'll be eager to watch Southwestern. I think they will report tomorrow to see what they do to manage both their Haynesville as well as their Marcellus positions. They certainly have some capacity, or relative to their takeaway capacity from the basin, they have some in-basin supply that they, it seems like they may, or possible that they shed in the Marcellus in particular. But how are they going to balance that outlook relative to this low price environment? Chesapeake also came out reducing, I think, 2 completion crews is what I saw. But again, in our opinion, we're kind of already doing that here. I have Chesapeake in this example running at 4 rigs, and they're not growing much, albeit, but they are growing. And so in our opinion, again, there just simply isn't the demand to support aggressive or continued growth, particularly in these gas basins.
And one thing to note too, when you look at the top midstream systems that those producers are on, one thing we do to get more confidence around our volume outlook is actually monitor those G&P systems as well. See the volumes, the flows behind those, that gives us more confidence of what the producers are doing, not just saying.
So how that force balance looks, I know, sorry I didn't build these out, but I basically say, even these producers alone at this reduced rig rate could grow 1.8 Bs on their own. So one of the things that we're watching in our modeling is, one, we're watching each of these producers to see what their rig levels look like. We track them, and you can see that on the right side of this chart. We track them by the systems that they are active on. So certainly Chesapeake, Paloma, and active on Williams system. We're also watching Southwestern on DTM, Comstock on ET. So we're watching those systems in particular to see if the rig levels translate to the volumes that we see come out of those specific systems, because that will tell us a lot about how many DUCs that the companies could be building potentially if they're choking back wells. That'll tell us a lot about potentially shutting in, but that'll tell us a lot about what's happening on those systems. And then certainly watching the throughput corridors out of Louisiana and out of that Haynesville market to see how are supplies shifting. Is it new production that's pushing out old production? Is it pushing back on the Marcellus? We'll certainly see that reflected in daily prices as well. But it'll tell us a lot about how the trajectory going forward will be. So again, I said this at the beginning, but if you're not watching the Haynesville, you're not watching that activity in the Marcellus, I think you could miss, if you're solely, let's say, focused on the Permian, you may miss what's actually happening in the market and not keeping an eye on that Haynesville and the Marcellus area. So let's look at that force balance. Here's that phased-in force balance where the beige area represents our base number. Again, that's sort of the December number. And so we wanted to look at, and we provide both these numbers in our macro, but we wanted to look at the difference between an unbalanced market, meaning we balance it by capacity, but we do not balance it by demand, and a balanced market where we take our balanced expectations for LNG and power and all the other rescom and industrial, all the other components of the demand curve, and say, what would it take to balance the market? And again, in our opinion, in the short term, there really are two levers. It's the Haynesville, and you can see that in the Arklatex graph at the upper left, and the Northeast. We've already started to pull back our Northeast numbers closer to that blue line, so that's a positive improvement or bodes well that we're closing in on a bottom. But our Haynesville number is still far too high. And so it's not closing in on that blue line. So that's what we're watching very closely, because if we don't see it come down there, we don't see a balanced market. Again, we could have higher demand. We could have LNG facilities run at even higher utilization than we forecast, which is about 90%. Certainly some of those things will factor into helping balance the market, but we've got to move 2.5 BCF per day of gas throughout the entire year. That is a lot of supply that we've got to manage.
Yeah, Justin, there's a question here about do you equate the increase in development with the resurgence of PE money rolling back into the space, especially in Tier 2 producers? I think it's a relevant question for this particular slide because of the future of some of these Tier 2 basins that you're seeing.
Yeah, I think there's certainly some of that that we've heard about, which is proving up reserves and proving up the productivity to start to move. It's not necessarily a bad idea. We're going to have a period of 3 years of low prices, which is going to impact it. I would argue, though, and we can talk about this maybe we close at the end. If you take a long-term view on the market, this is all going to be needed long-term. So, a short-term move in, if you're an investor, a short-term move in supply markets might push some of the valuations down, might push some of the midstream company valuations down. To me, those present opportunities because the long-term thematic trend of the U.S. being a global supplier, of seeing more demand, of production having to rise, and the prices having to be there to stabilize that is in place. Because you can look at that curve, those curves right there in that graph, And it's a good segue into, we have basins that are at the current curve suggest they don't grow, but at our balanced market curve with all the expectations of more LNG and more demand, you're going to need these tier 2 basins, Anadarko and Eagle Ford and the Barnett and even the Rockies to a large extent. I'll talk about some of the gives and takes there, but in our opinion, it can't all come from the Haynesville. It can't all come from on the Permian. That's too much exposure, and I think there are some limitations on what those basins can prove. So let's look at that LNG trend. So a couple of things to note here and to focus on. One, we've got a massive growth trend. And I think you could look at this and say, man, these guys are aggressive on LNG, and that certainly could be the case. In fact, I would argue that over the course of the next few months, we're probably going to taper that steep incline in LNG demand back. I would say, though, that if you look at the dotted blue line, that is the SPAs we have signed. So we already have 24-ish BCF per day of SPAs signed. So getting that incremental 5 to 6 BCF per day of SPAs is not a large lift. We're obviously seeing a lot of movement in the market and a lot of discussion around that. But in our opinion, as prices come down, as the world continues to focus on a more secure energy source, as the global markets look to decarbonize and potentially replicate the amount of decarbonization the U.S. has benefited from increased power demand, where we've increased the amount of demand from power plants by 30% and reduced our carbon footprint or the carbon emissions from the power sector by 30%. Those are big numbers and big movers that I think incentivize the globe to shift. The last point I'll make here on this one is the yellow line. We do run our facilities at 90% utilization. So when you think about demand, like even next year, we aren't anticipating an outage. We aren't anticipating a lot of volatility in LNG demand next year. To the extent that happens, that could put a lot more pressure on prices. There's not a lot of upside there because, again, we run those facilities in our modeling. We run those facilities at 90%. The risk long term, and we'll get to this in some of the big conclusions, is it fair to run U.S. LNG output at a base load? And you can see that yellow line is very base load to the world. We're not on the margin. To the extent we become on the margin and you see a lot more volatility in that, that creates a lot more volatility in the U.S. market. In my opinion, some huge opportunities for storage development. We haven't built storage in the U.S. Really in any big significant way since 2008. And we could see a huge resurgence in the desire to have backup or the ability to arbitrage or leverage or to manage that volatility.
Yeah, Justin, I think one of the beauties of monitoring this on a daily, weekly basis for us is there will be, we get a lot of questions on, will all these be built? What's that going to look like? Can we build them all? Can we supply them all? Reality, I think, and I'll plug our friends over at Hart Energy, they released this morning that Cheniere is at Sabine Pass is looking at building 3 more trains. There will be some winners and losers within this mix. But I do think that that gives us confidence in our thesis that we will get this stuff to the water and we will continue to produce into it, and we will see that growth there.
Yeah, it's a good point, Chris, because it's not like, we've certainly made some guesses and some estimates on what we think is going to get built. I mean, we've included facilities, like Cameron, it's only 17% contracted. Or you can look at, CP2, which is only 31% contracted. They aren't FID. They aren't fully contracted yet. We've included them in our numbers. But we haven't included, to your point, Lake Charles, Sabine, Cheniere. So, whether some interchange or one goes out and one goes in, we think the market's there to support it. It's not entirely clear which facilities will get built, particularly the ones that are not FID'd. We'll be watching. I don't think we've seen a Port Arthur FID, but they're 78% FID. Contracted. I don't think we've seen a Commonwealth LNG FID yet, but they are 75% contracted. So these are facilities we would expect to FID this year. And then there's going to be some others that, come in as flyers. Again, we didn't include in this graph we didn't include, companies like Tellurian and Freeport, and maybe for obvious reasons, but there certainly could be some shifting and changing hands and shuffling of the deck a little bit, especially with the non-FID facilities. And speaking of which, here's the FID versus the non-FID. So the gray area is our FID facilities. So it's just basically a differentiator between the last slide and this slide, and then the colored stacked on top is the non-FID facilities that we're watching very closely. Again, I mentioned, we'll see about Louisiana FLNG, whether that's coming up pretty quickly here. So we're probably going to have to make a call on that, whether we still expect it. We'll see about some of these other ones that, like CP2, as I mentioned, we expect. Cameron is interesting. Lake Charles, I think ET just announced the other day that they're on their earnings call or in a notice that they said that they're seeing a bit of a slow tightening in the contracting market. Yet again, that's offset by Cheniere announcing they're going to do a new facility. So what I would say, though, is I think our timeline here, if you're looking at that ramp and saying, man, Justin, that looks aggressive, I would tell you I agree. And we'll probably shift some of that back, because not only does it seem a bit aggressive from a timing standpoint, but it also seems a bit aggressive from, can we physically build all those facilities in that short a time frame? That feels a little tight.
Yeah, and Justin, I think, back to that previous slide, when you look at it and you look at the contract capacity, it still shows we need above and beyond the current FID projects. Now, will some get recontracted? That's because of higher inflation and labor costs. We are watching that as well.
Wouldn't be a good deck unless we talked about the Permian. So let's talk about the Permian. As I said, during this phase one period, we don't expect the Permian to play a large role. Now, as large a role up until those new facilities come online. But during this phase one period, we expect the Permian to remain constrained, meaning basis will be under pressure. Producers, to the extent that they're exposed to gas prices, will be under pressure. There'll be spreads to take advantage of out of the Permian. So if you own capacity, there'll be a market there to move supply and benefit through that entire phase one period as we bring on PHP and the expansion of Whistler. And then ultimately, as we get into 2024 and we enter that phase two, we'll see Matterhorn come online. We do expect Matterhorn to fill. That'll fill, and you can't see it. We project in this graph. You can see we forecast by a function of trying to determine the financial outlook for many of these assets. We have to forecast the volumes for every asset. That's, as a business process and a methodology process, we basically build little mini P&Ls for 1,200 assets across the United States of America. And forecasting volumes is a part of that. Volume times rate. It's not much more difficult than that. And so we expect that the Matterhorn will fill and start to pull away from potentially some of those northern bound pipelines to pull some of the supply out of those. One thing to note here, and I didn't say this earlier, and I should have mentioned it in our forced balance. One, we cap in the forced balance, we cap the Arklatex market at about 90 rigs. Could you run it harder? Yes. We felt like capping it at 90 rigs seemed reasonable for just the size of area it is, and to sort of project out the available acreage, the drilling locations in a sort of 10-year time frame. Could you run it to 150? Yeah, that's certainly possible. In our minds, that just steals or takes away some of the potential near-term growth for some of those tier 2 basins. And the other thing with the Permian, you'll notice that there's a little capacity between the stacked throughput on all the pipelines and then that red capacity, which represents our effective capacity leaving the basin. that area could certainly get filled up. We backwardate that curve, as I mentioned before, allowing rigs to fall. To the extent that there's higher productivity, to the extent that prices are higher, we could certainly see that fill up. And that would expedite, the construction of, let's say, WOY or a GCX or some other pipe that's yet to be announced or has been announced and is not on this list, that allows them to fill those, get the contracts needed that allows them to fill. I think Warrior or ET had said on their earnings call that they didn't have sufficient capacity for Warrior. And I don't want to be misquoting here, so certainly go look it up. But I think they said they had up to 60% interest in it, but it only signed a lesser capacity in terms of contracting. So I think they're working towards that, and it's entirely possible that they're able to get that as we see productivity and demand start to increase in the future.
Yeah, Justin, you make a point on the effective capacity, and I think it's a good point because the gas is going to flow where it's needed and where the prices are right. So if you look at the Permian as a whole and one big piece, you're not looking at the individual dynamics that could affect how it plays out. And so we look at all the pipes, where they flow, how they fill, and what the demand centers are on those pipes to get a better look into what the Permian is going to do.
Yeah, thanks, Chris. There is a blue line there, or I think it's kind of purplish, that represents the rated capacity of those pipelines. To us, it's worthless. Looking at the rated capacity of a pipeline without considering effectively what can it flow, like, again, considering as an easy number or an easy point of reference, considering every pipe flows to Mexico could run full is sort of worthless because they can't run flow. They won't run full. There's not enough demand in Mexico to absorb it. So they're effectively limited, and that's why it's called effective capacity. They're effectively limited by downstream constraints, whether they be demand or choke points or whatever. So that's where, that red line of effective capacity represents where we expect to see prices blow out, where we expect to see basis blow out. And that market separate, and that's where it impacts, producers, exposed to in-basin pricing, creates the spread opportunities for folks that have capacity, all the fun stuff that creates an interesting dynamic market. So if we shift our focus back, so I talked about the Permian, and we shift our focus back to the Haynesville, and just that upper Louisiana market in general. So a little less focus on the Haynesville and a little more focus on that upper Louisiana market. In here, I've mapped out that blue forced balance projection of what the Haynesville could do. And then it's, again, capped at about 90 rigs in there, and that's where you can see it sort of runs up and sort of tables out there in that 2029 timeframe. And then the gold area represents what's coming in today. So inbound supply as we balance in, particularly the Marcellus coming into the region. What the gray area represents is then all those other basins, in particular like the Anadarko and the Barnett, that are coming through the area and could see additional opportunity as demand shows up and as we start to hit those upper thresholds of LNG growth in the market and in the lower Louisiana market. That 13.76 BCF per day of demand that I alluded to or showed in one of the earlier slides. If that is the case, the red line, which represents capacity, is not sufficient to support the amount of supply that would want to come through that area. And we would need more pipes to support that amount of growth coming out of the Barnett, coming out of the Anadarko, coming through, possibly down from the Rockies, possibly down from Canada, coming through that market as supply shifted and started to move down into that lower Louisiana market. Again, that's a long-term expectation, and I'll get into the last slide of the deck here next, which we'll say, well, what happens if that isn't necessarily needed? Again, I'd also argue if you disagree and think, well, Justin, that 90 rig cap on the Haynesville is arbitrary, well, then we might need some new capacity for just that Haynesville supply. But whether it's Anadarko or Haynesville or whatever, we will need, as I alluded to in the map at the very beginning of this, we'll need more capacity and more interconnectivity, likely needed to support the amount of demand growth along that Gulf Coast.
Hey, Justin, we got a question here that I think actually plays well here. The question is, do you equate the increase in development with the resurgence of PE money rolling back into the space? especially in the tier 2 producers. And I think one thing I would say there is, I think the PE money rolling back in is probably rolling back in because there's opportunity. And this slide really represents that opportunity. If we are trying to get the gas to the water, right, the Haynesville is going to be a major player, and some of this is going to play out in those basins that you talked about in the gray area.
Yeah, again, I think private equity, I don't know that I can directly equate the private equity money rolling back into the space into tier 2 producers. What I would say is if it's an advisable thing to do, because again, I believe in the long-term potential of gas markets. And so as I think there's a huge opportunity to pick up producers, infrastructure that supports this dynamic longer term. I think there's a huge opportunity to do that now. And that, I believe in the long-term outlook for hydrocarbons in the U.S. and that regardless of we're going to need it all, to be perfectly honest, as we develop more renewables, more wind, more solar, but the economic growth suggests that we just need all of it. And there's countries right now with rolling blackouts that are going to need our LNG. And those are, so again, I don't know that I can attach the PE money directly to it, but I would say it's a smart move.
Yeah, thanks. And I think as you can tell, everybody on this call, as bearish as prices are now, and when we're looking at it, we are super bullish on America being able to help with the natural gas demand and energy demand of the world in the future.
One last nod to that growth scenario, and then we'll get into some conclusions here. But the last nod to that growth scenario is in this chart. What we rolled out is both first in the blue area the demand growth expectation of FID facilities, and at the red line it's the tier 1 incremental gas growth or incremental production growth. So if you don't believe in an uber aggressive or too aggressive of an LNG outlook, we simply can knock off the difference between the red and the orange line, which are those tier 2 basins. And we can start to pull some of those back. Now, again, we didn't pull this graph out further than 2030. I would contend that, we're not really pulling it out. We're just deferring it for longer. But nevertheless, if you don't believe in that short-term trend, it just says, hey, we maybe don't need these tier 2 basins. And so that, the growth there is not as essential. But again, we take the opposite view, and we think more of these facilities will continue to get contracted, maybe at a slower rate, maybe at a slightly deferred construction schedule, but nevertheless, they'll come online at some point. So let me jump into some conclusions here, and these are different from the themes in the beginning, and I want to hit on some of the key points I hope I hit on as we went through these. But one, short term, prices have to be low enough to curtail well completions or shut in supply. In my opinion, it is not enough to reduce prices enough to just reduce rig counts. We need to see supply curtailed either through not completing wells or through physically shutting in or choking back wells. And the prices have to be low enough to support that. That's going to differ by basin as to what, and by producer as to what they view as low enough to force them to start to curb supply, and something definitely worth digging in with each and every, let's say, producer you're invested in or counterparty that you have. Second, producers in the Haynesville and Marcellus will determine how low gas markets go. I think it's beneficial or positive to see Comstock slow down a bit. It's positive to see Chesapeake slow down a bit. I think it'll be positive to see Southwestern slow down a bit. In my opinion, I don't know that they're doing enough in order to curb the amount of supply growth, and we're probably going to see prices go lower in order to sort of force the issue. Again, I'm not suggesting it's them, but it is somebody.
Yeah, and Justin, I'd say we're watching this closely with the producer growth. You'll see more from us from a content standpoint coming out there, but that is probably top of our radar right now.
Gas markets are long, and prices will need to stay low to defer supply growth. So this isn't a 23 timeframe. And to the extent that we get a blazing hot summer, and we're just consuming a ton of gas, in my opinion, that's just deferring the problem, because this is not a 23 problem. It's a 23, it's a 24, and it's a 25 problem. So we're deferring, we're just kicking the can down the road. So definitely watch markets, because I think markets will respond the way markets respond, but we're kicking the can down the road. We're just going to be back to this same scenario, even if prices go higher and send the wrong signals to producers to produce more, to hedge more. And then third, long term, there's not enough interconnectivity to feed all the LNG expansions and all that LNG growth. And we're going to need more. I think there's a huge opportunity for storage market expansions, for storage facility expansion. Again, something that we haven't really seen in any significant way in over a decade. And there's a huge opportunity there for investment in those. And then I think significant opportunity for tier 2 basins, the timing of which might be delayed, again, depending on that ramp in LNG. But I don't think it can be all about the Haynesville and the Marcellus and the Permian for many reasons. One of which even is just exposure and having diversity of basins that are supplying markets in case we do have issues, with pipe connectivity and how production gets out.
Good. Justin, to jump in here real quick, we had 2 questions. One was, can we burn our way out of this? And the other was, why don't we look at European demand? And I'll give my 2 cents, but I'd love yours. Is one, with European demand, we still have to get it there, so we're building facilities. And with burn, we actually did do a calculation on burn. Now, this isn't taking into account some higher demand from industrials and stuff, but we would literally have to have the highest demand on record for all 12 months of 2023 to burn our way through the current supply. So I don't know where everybody lives, but I was in Toronto in January and it was raining. Denver's been pretty warm where we're located, and I was in New York and I could have worn a t-shirt. So we're not hitting that. We're not going to see, I don't think, that highest demand on record. But Justin, I'm curious your points on there, or your thoughts on those 2.
Yeah, I think I talk about the whole burning our way out of it, just with respect to, I think it sends the wrong signals. We can try to burn our way out of it, and I think, obviously we can do a lot there, but nevertheless, it'll just defer it, and I don't think you can defer it for 3 years straight by trying to burn our way out of it. I think that's markets just don't balance that way very well. So I don't know that burning our way out of it. It's a short-term strategy. I don't think it's a long-term fix. And then your second question, Chris, was on
European demand and why not take advantage of the higher demand? And my point was we still have to get it over there. And
yeah. I mean we are capping our LNG output at 90%. So you can't run those facilities at much hotter than that on a normalized basis. So we don't see a lot of opportunity there. But there's a question here about assuming Waha gas, and we're jumping into the questions. If you have some, there's I think the question box is down at the bottom, and feel free to tone in. To the extent that we don't get into questions as we're running short on time here, we will follow up with you. We'll download this list of questions. I think we have that capability, Chris.
We do.
We'll download this list of questions and shoot you an email. I mean, Waha in my mind does go negative. And do you see the excess growth being self-regulating? I'm not exactly sure what that means, but I'm certainly happy to follow up on will it be self-regulating. The issue with gas is it's not the primary driver of production growth. And I mean, interestingly, we're watching rigs go up in the Permian despite gas constraints. And so that's what's really going to send Waha negative, and it probably won't be as self-regulating as it needs to be, because unless we see a move in the oil curve, it's not really going to have as much of an impact on the break-evens, because many of the break-evens for most of those producers there we're talking $45, so they're still making money at oil prices where they are. The other thing that we didn't talk about this a lot, but to the extent you're interested, please give us a call. Is NGL markets. We're hitting this gas constraint now, and that's certainly top of mind, and you can see it reflected in gas prices and Waha basis. But we're very quickly going to run into a frac constraint, and we actually already have, and we talked about that in DLS. We actually talked about it a year ago at this exact same time, just seeing the trajectory of supply growth that I showed in gas. carried through to the NGL markets and the inability of frac markets to take that, which meant rising fractionation rates. And we're seeing it, to the extent that we're now, seeing mothballed fracs start to get turned back online. So, this is a market that is going to continue to hit those. And then, to the extent that we then see the resurgence of that gas growth, we're going to actually get into a point here long term where rates are going to start to climb on oil pipes, and we're going to need more oil pipes. Now, this is a bit of a couple years out. We talk about it in DLS. Again, take a look. But at the end of the day, we're going to start to see that some of that oil, us hitting an oil capacity constraint.
Hey, Justin, one question I think we'd be remiss not to address, because we talked about it internally, is will global LNG become oversupplied in new Gulf buildouts? And we had discussed this about America becoming the base load provider of energy for the world, and it's something we're looking at. And up until then, our conclusion was it's going to be really volatile, and if that doesn't happen, then it's going to be super volatile even after that. I'm curious your thoughts on that.
Yeah, I mean, I do think that global LNG will become, or U.S. will become a baseload supplier to the world. That's where that storage, to coin, maybe say the U.S. might be the storage coffers for the world. I mean, we've got the geology and the salt caverns to support a highly flexible, responsive, dynamic supply source for global markets that ebb and flow with weather and with geopolitical issues of supply constraints. So I certainly think that the U.S. could be the storage coffers for the world, and that the LNG market, and that's one reason why I think the LNG market is a robust market for the U.S. that will continue to grow.
Yeah, I appreciate that. I know we're at time, so if you ask a question, we'll make sure to get back to you. And also, we will share these slides, and I'm going to do a shameless plug for some of our stuff. So if you haven't already, sign up for our Natural Gas Watch. It goes out weekly, or Natural Gas Weekly. Goes out usually after the EIA storage balance comes out, and then we give our ideas of the market. We also have a new macro supply demand, where if you like our volume outlooks, it's a very simple and easy way to begin to work with us. And it gives you an idea with the data behind it of our views on the nat gas volumes that are flowing throughout the United States.
And you don't have to like our volume outlook. There's a bunch of people on the floor here that are much smarter than me that would love to talk to you about our opinions on basins and producers and gathering systems and infrastructure. And so you don't have to like our volumes, but I think you might like the people we have here, and we'd love to talk on the phone. So, please, would love to have you as a client, love to have you sign up for Macro, would love to have you talking to our people.
Yeah, appreciate it. So look for an email with the slides and how to sign up for the Nat Gas Weekly here coming up. Thanks, everybody.
Thanks, everybody.